Good evening, everyone. Time for another silver update. This is the 4-hour chart, and we've drawn a number of trend lines here. You can see that we are holding with this trend line. It's got a couple of tests here. We bounced off it today, and we have some descending trend lines here forming this flag or pennant formation as we rise off the bottom. Now, we had some very interesting volume today. If we add the volume in, you can see we actually had a tremendous volume spike, one that is barely only rivaled by the May SmackDown volumes that we saw. This volume came on the downside. Some of these came on the near the bottom, and this one was on the upside. So I wanted to squeeze in a little bit closer to try to determine how much of this volume came in at what time. And you can see if we draw a line straight up from where actually we need to get a little bit closer. We'll go to the 5-minute. We draw a line to where the bulk of this volume came in. You can see it came in roughly about here. So this appears to be, there's some volume on the downside, but a lot of volume coming in on the buy side. If we pull all the way out to the daily, you can see it. We get a big spike there. So this may be a strong bottom, short intermediate term bottom that we've put in here. Here's a view from the 1 hour. You can see how big that spike is. So that's a pretty big volume spike. Looks like some buying coming in. We'll see if it continues to the upside. Now, the main news that I wanted to look at today, and I apologize, I'm not going to be able to finish the Dollar Vigilante article. It's just too long, and I have that link. You can go ahead and finish reading it for yourself, but I'm not going to read the rest of that. I just had too much I wanted to cover. Now, the main news that we've seen, I'm going to go ahead and clear off all the indicators. One of the big news stories that we saw recently, and I've been pointing this out over the recent term, is central bank intervention. We had a tremendous central bank intervention occur on the 29th, and you can see that they rallied it from about 75.6 all the way up to 79.6. It's about a 4-point move, a huge move. You can see as we move out, it's really only rivaled by the rally that they did off the Fukushima lows, which was a very large rally. So if we put the volume in, it doesn't rival this spike, but it comes close to rivaling anything we've had since that. So a very large move. At one point here, if we look at the price, and it was mentioned on Zero Hedge, we had this trading band here, I'll call it, and you can see if we go closer in, I don't think we have it on the 1 minute anymore. No, we don't. When it was on the 1 minute, you could see it clear, much more clear than you can here. But if you look at the volume that occurred while this was trading in this band, you can see the volume spiked very high, then dropped off, spiked again, then dropped off on no price change. So that was starting to shape up to look like some kind of currency peg. And of course, it rallied off of that on strong volume, and then it collapsed. So now it's kind of finding a price right around here, kind of looking a little bit like a currency peg, maybe around 78. Now, if you remember, the last intervention we saw that roiled the markets quite a bit was the intervention in the Swiss franc. If you remember, they pegged the Swiss franc to the euro, and that was the last intervention that we saw. Now, you can see that occurred, I believe that occurred around here on the 26th. but it may have been this rally right here. So if we look at silver around that time, we've got 27th, 29th. No, actually, I need to go back farther. It was farther back than that. This was the intervention. I'm not sure which one it was. So I believe it was here, and we had the Swiss franc devalued essentially because it was rallying so strongly against both the dollar and the euro. And we want to compare and contrast the timing of that. Now you'll see why when I get into the topic tonight. But you can see that's roughly about August 10th or so. Then we look at the price of silver around that time. You can see that at around that time we rallied a little bit. It really doesn't coordinate. So not a lot you can take away from that, but there was some significant moves in the Dow. Now with this recent intervention in Japan, if we go into the close-up view, we can see that this occurred about the 30th. And if we go to gold and silver, we can see that right around that time we had this drop off. Now we're rallying back, so the initial market reaction was for gold and for silver to fall on that news. So why am I pointing this out? The reason why I'm pointing this out is what the idea I'm going to propose is that this is, I'm going to call this episode Shiny Object, and any of you who've heard that term, familiar with it. Basically a shiny object is something that gets you to look away real quick to distract you from something else that's going on. So my thesis is that what is going on in the currency markets really doesn't have too much to do with the stated reasons that were being given, but has more to do with the US dollar and of course gold and silver. So the first thing I wanted to read to you is, I've followed these reports for a while. I've never covered them on a silver update, but I have followed them fairly closely. They're the LEAP 2020 European analysis of the crisis, and the global systemic crisis was fairly well predicted by these people. The difference is their perspective, and I'm going to read a little bit so you can see their perspective here. They say, our team could address this issue like the Anglo-Saxon media, the President of the United States and his ministries, Washington and Wall Street experts, and on a wider basis mainstream media have done recently over all aspects of the global systemic crisis. That's to say, by saying it's Greece and the Euro's fault. It would obviously be a virtue to reduce this part of the GAAP to just a few lines and suppress any hint of analysis of the possible causes in the US and the UK or Japan. But coming as no surprise to our readers, it won't be LEAP 2020's choice. And they go on to how they anticipated the crisis. In this case, for ages, when one thinks of banks, one thinks first of all of the City of London and Wall Street. And with good reason. London for over 2 centuries and New York for nearly a century have both been the two hearts of the international financial system and the lairs par excellence of the world's major bankers. Any global banking crisis, as any major bank event, therefore begins and ends in these two cities, since the modern global financial system is a vast process of incessant wealth recycling developed by and for these two cities. Now, that I agree with, and the reason why I'm bringing this up is because I wanted to jump over here and look at Greece real quick, because Greece has been in the headlines, and a lot of the news that we hear is about Greece and what's going on with Greece. So I wanted to look at some of the numbers real quick. Now, Greece has a population of approximately 11 million people, roughly half of them in the workforce. They have a public debt of $329 billion. Their budget deficit is $24 billion. Now, these are older figures, but they're close enough. Their revenues, now this is really important, let's look at this. Their revenues are 89.7 billion euro. I'm sorry, these are euro, not dollar figures. And their expenses are 114 euro. So here's your ratio. You've got bringing in about 90 and spending about 115. Now, what does the United States do? If you remember the most recent figures I read to you, the United States is spending roughly 3.7 trillion and only taking in 2.2 trillion. So obviously, if you go by the revenues and expenses, the United States is in much, much worse shape than Greece is. Now, if we take the public debt and we multiply it, we need to multiply this by about 30 to get the equivalent for the equivalent population. That brings this to about $10 trillion. So the United States at roughly 15 trillion is still 5 trillion ahead of Greece. So it's my opinion, and the opinion of others as well, that actually the United States is in much worse condition than Greece is. But as you'll note, in the United States we have around 1% interest rates. Well, I don't even know what they are in Greece. We'll see that in a little bit when we look at some of the economic statistics regarding the countries. Now, the reason I'm bringing this up is that it's my contention that most of these intervention and crises are mainly distractions by the City of London and Washington, D.C. to distract the world from the real crisis. And of course, the real crisis is the dollar and how it is weakening against gold and silver. Now, with this Japanese intervention, like the Swiss intervention before, we've got a rally in the dollar, and this is the shiny object. This is look over there, look over here, look over there, but don't look at the real issue. And the real issue, of course, is the United States and its horrible current account deficit, its horrible trade balance, and its incredibly awful debt and deficit that it's running, and the weakness that that's going to portend if the world finally concentrates on the elephant in the room, which is the United States. So to show you that, I wanted to look at the Japanese yen. This is the most recent intervention that the central banks have managed, and as I pointed out before, the central banks operate with punishing rallies, so that anybody who is trying to make a fundamental bet based on the market fundamentals of the respective countries, who carries any kind of stops whatsoever, is going to get blown out of the market. So obviously the central banks are trying to make it so that the little guy or even the moderate guy can't play this game. But when this occurred, we had an explanation. You can see that the dollar yen, and this is just the dollar yen, you can see it also, it's most prominent in the Great British Pound yen cross as well. But a key point is that when this intervention occurred, the Great British Pound yen cross was not going into new lows, but the US dollar Japanese yen cross was just ticking into all-time new lows when this intervention occurred. Now, the explanation given for this, and I'm going to address Switzerland as well, but the explanation given for this that you see universally across the press is that this was an intervention by the Bank of Japan for the purpose of weakening their currency, because they have an export-based market. Now, I'm going to look at some balance of trade figures and some other figures so that you can see why I believe this argument is bogus and this is just a shiny object. I believe that the United States was behind this move by the Bank of Japan. And I believe the United States was also behind the move by the Swiss Central Bank to peg its currency to the euro, to weaken their own currency. So it's my belief that it's not these central banks trying to protect their economies, but is actually pressure from the United States and possibly the City of London to keep this game going. Now, I want to demonstrate that by taking you over to a fairly neat site that I found, because I was trying to pull information about trade balance and other indicators so I could try to make this case. Now, this goes back quite a ways, so the first thing we're going to pull here is the balance of trade for Japan. So if we'll just go ahead and pull this all the way out to 1986 and get the balance of trade for Japan, which actually is starting to weaken here. Now, what I want to do is compare these figures and the explanation that's given, the standard explanation. So let's start with Switzerland because Japan's not that clear. It's a little bit more complicated. But let's start with Switzerland. So we can pull a lot of countries here and we'll just choose Switzerland. And then the first thing we're going to choose is their currency, and we'll run it back to the Swiss franc. Has been around a long time, so we'll run it back. So this is a US dollar Swiss franc exchange rate, and you can see that the Swiss franc has been steadily strengthening against the US dollar. All this goes all the way back to the early 70s. So at the very beginning of this time period, the Swiss franc, it took about 4 Swiss franc to buy a dollar. Just recently, right around the time of the intervention, the Swiss franc had dipped under the 1-to-1 level and actually took less than 1 Swiss franc to buy a dollar. So the dollar became at this point worth less than a Swiss franc. So I want you to keep this trend in mind, that from the early 70s, the Swiss franc has gained on the dollar this entire time. So the dollar is weakening, the Swiss franc is strengthening during this length of time. And let's pull up the balance of trade. This is the balance of trade back to 1989 in the country of Switzerland. Now, you can see that, so this period, we're going to select this period and just go from about January of 1992, where we're steady, through 2002. There's about 10 years of ups and downs, and starting in 2002 we have a gradual increase in the trade balance of Switzerland, which means that Switzerland is exporting more than it's importing. It has a positive balance of trade. So if we go back to the currency, we're looking at 92 to 2002 and then forward to the present, and we'll just choose 92 on this chart. Okay, so from 92 to 2002, the currency stayed roughly the same. From 2002 to the present, the currency of Switzerland strengthened by twofold against the dollar. So if it's the case that a strengthening currency harms a country's exports, then we don't see that all in the case of Switzerland. Because you can see from that period in 1992, their balance of trade has risen steadily with a strengthening currency. So that's the first case I want to make, that these two are not correlated at all. Although you will hear that repeated in the mainstream media time after time after time. That was reason given for the Swiss intervention. It's the reason given for the Japanese intervention. Now, as I said, the Japanese is a little bit more complicated, so we'll do that one last. But let's pull up the United States and take a look at the currency. Now remember, this is the US dollar basket index. This is not a cross. The other was a cross against the dollar, but this is a basket. We'll pull this back from 1971. You can see that all the way back in about the late 70s and early 1980, the dollar touched down to about 80. As they've been intervening and fighting these currency wars, the dollar's ducked below 80 recently, but has been bouncing back up and hovering about 80. So for all intents and purposes, excluding this spike that we have here, this was the Plaza Accord. This was the Reagan run-up and the Plaza Accord run-down, which accounts for nearly doubling in the value of the dollar and then a subsequent crash. And this run-up here, if we zero these out and look at this overall time frame, the dollar pretty much has stayed steady in its basket. So let's go ahead and pull up the balance of trade for the same period. Unfortunately, we only have 1992. So you can see, starting in 1992, the balance of trade for the United States has decayed considerably. And these are in millions of dollars, and you can see this is an enormous trade deficit, an unbelievable trade deficit. You can see that it improved fairly dramatically with the recession, and then it fell back off. So we want to go back to the currency and pull just that date of 1992, because that's our comparison period. And you can see the US dollar has been basically flat for this entire period, while the balance of trade has absolutely fallen off a cliff. So there's another instance of proof using the numbers that this contention is not true. So let's go to Japan finally and look at their figures and pull their currency. Now remember, this is just the US dollar. Actually, we'll pull the balance of trade to find that earliest date, and that's 1986. We have a steady surplus balance of trade until we have a drop off in the recession, then a rally, and drop off, and now we're rallying. So we want to pull the currency back to 1986. And you can see that the Japanese yen has been steadily strengthening against the dollar, roughly by 50%, from 160 to 80 over this period of time. And the balance of trade was climbing all the way through here. Just recently had it dropped off. And it's my contention that it actually has to do with other factors. I don't have time to go into those factors. I personally believe that the factors that have a lot more to do with the balance of trade being thrown off so much has to do with government deficits and the printing of money. And that's Jimmy Rogers' theory, that the trade deficits actually come from budget deficits, not from the currencies. So I think I've shown by these charts that the current explanation in the press for these interventions doesn't hold water. And if it's the case that these interventions are not being done by the Bank of Japan to try to strengthen their exports, but rather probably are done at the behest of the United States government to keep the dollar from collapsing, then this is what I call a shiny object. This is a distraction and an attempt by the government of the United States and possibly the City of London to distract the world once again. Look over here, look over there, look up, look down, but whatever you do, don't look at the United States dollar, the United States current account deficit, the United States balance of trade, the United States budget deficit, and the United States debt, because those are the gigantic bombs that are about to explode. And they're trying to keep us looking at Europe, they're trying to keep us looking at Japan, but the real story is the United States and its collapsing economy, its collapsing currency, and its collapsing government, essentially. And eventually the City of London and the United States, Washington, D.C. governments that are controlling the currencies of the world and suppressing the price of gold and silver, it's my opinion that they're going to lose this battle, and they're just staving off the inevitable, which is going to be an explosion in the price of gold, an explosion in the price of silver, and hopefully not, but possibly the collapse of the Western governments. And we'll talk to you next time.